Financial Pickle here. In part 1 of this video, we looked at how retail traders like you and I lose money by holding long in-the-money calls into an X dividend. It often puts you at an unnecessary disadvantage and sometimes causes you to lose an entire dividend's worth of value when it could easily be avoided. It's estimated that between January 1996 and April 2006, traders lost almost $500 million from this. And with option volume skyrocketing since then, that number would almost certainly be much higher now. And most of that lost money is going to market makers and other large institutions who know how to take advantage of people that don't make the optimal trade. Now in part 2, we'll go over how to identify if your long calls are at risk of unnecessarily losing value and what specifically you can do about it. There's also a spreadsheet that will make the job much easier for you. If you've seen some of my previous videos, then you should know a little bit about synthetics. They're designed to be nearly identical to a particular strategy, but they use different building blocks to get there. For example, in my video about the wheel strategy, we looked at how a short put is nearly identical to a covered call. But in this video, we'll be looking at the synthetic alternative to a long call, which is made by buying the stock and buying a put with the same strike and expiration as the call. Here's a quick example to show you how similar they are. ABC stock is trading at 100 and the 100 strike call and put are both trading at 5. With the long call, you make money infinitely as the stock goes higher and higher. Your max loss is the $5 premium paid and the break-even price is $105. With the synthetic long call, it's the same thing. The stock lets you make money infinitely to the upside, the long put caps your losses at 5, and the break-even price is $105. But the synthetic long call will never lose value unnecessarily going into the X date, so we can use it as an alternative to the long call to have basically the same exposure as we did before, but without the dividend risk. However, the big difference between these two trades is how much cash you have to spend on each one. With the long call, we're only spending $500, and with the synthetic, we're spending $10,500, a difference of $10,000. This difference plays a big part in how options are priced, which we'll look at in our next example. This is Bank of America on their June 7th ex-dividend date. We're looking at the $30 strike for the August 16th expiration. The long call is worth $10.15, 37 cents of which is time value, and the synthetic long call is $39.84, where 6 cents is time value. That 31-cent difference in time value will affect the profitability of each trade, as you can see in this comparison. At this point, it looks like the long call is at a disadvantage, but what we haven't looked at yet is that cash difference we talked about in the previous example. The long call will cost $1,015 and the synthetic will cost $3,984, a difference of $2,969. The options market will price in this cash difference using the risk-free rate, which is why that 31-cent difference in time value exists. That is approximately how much interest you would earn on that $2,969 for the remaining duration of the option. Let's do a quick calculation so you can see for yourself. There are 70 days left until expiration, which is about 0.19178 years. The risk-free rate at the time for the 70-day duration was about 5.38%. When you multiply the 2,969 cash difference, the 0.19178 years, and the 5.38% risk-free rate, you get about $31. Then divide by 100 to get the per share figure of 31 cents. That 31 cents is what makes the long call equivalent to the synthetic long call. With the long call, you pay an extra 31 cents of time value, but you get it back in the form of interest on the cash difference between the two trades. This relationship between a call and the same strike put is known as put-call parity. The formula states that the return on a call option plus the interest on the cash difference at the risk-free rate should equal the return on long stock combined with the long put, which is exactly what we just looked at with Bank of America. However, the formula is meant to be used for European-style options, but it does also work for American style options when it's not being priced in that early exercise will be or might be optimal at some point before expiration. An early exercise is not optimal in our Bank of America example, which is why the formula worked. In a future video, I'll go over when it's optimal to early exercise your options in much more detail. And if you do some basic algebra to modify the formula, it states that a short put plus the interest on the cash difference is equivalent to long stock plus a short call. This was the basis of my video about the wheel strategy where we compared cash secured puts to covered calls. So because we're using basically the same formula in both videos, the spreadsheet we use will be very similar as well. You can find it right now in the video description. The main purpose of the spreadsheet is to use it the day before the ex-dividend date if you own an in-the-money call. It uses the put-call parity formula to estimate the performance of each side of the formula until the expiration date of the options. If early exercise for the dividend is optimal, then that will be reflected on the spreadsheet by showing that the return on the long call will be lower than the return on the synthetic call. If that's the case, then holding the long call into the X date will be suboptimal, and it would instead make more sense to turn it into a synthetic call. However, if early exercise for the dividend is not optimal, then the return on both sides should be equal. The spreadsheet also assumes the stock won't move, which will almost never be the case, but it won't make a difference either way because the two trades will have almost exactly the same return no matter where the stock goes, except in situations where early exercise is optimal. And I'll explain why later, but for right now the spreadsheet should only be used if the stock only has one X dividend until the options expire. In the examples you're about to see, we'll be comparing the spreadsheet from only one day to the next, the day before the X date and on the X date, even though it estimates the performance of the trades until the expiration date of the options. And we do that because performance discrepancies between the two trades will only exist if early exercise for the dividend is optimal. And on the X date, that dividend will no longer be part of the equation, which also removes the performance discrepancy if it was there. So if there is a performance discrepancy, it will all happen overnight into the X date. Now, let's use the spreadsheet with the Bank of America example we just looked at. Simply enter the information highlighted in gray and it will do all the calculations for you. With the long call, we pay 37 cents of time value and receive about 31 cents of interest on the cash difference, for a total loss of about 6 cents from now until expiration. And with the synthetic, we pay 6 cents of time value for the put and we receive no dividends because right now we're looking at the X date, not the day before. So the total loss for the synthetic would also be 6 cents. As you can see, the two trades perform the same and put-call parity exists, which is also what we determined when we did the calculations manually. Now that you have an idea of how the spreadsheet and put-call parity function, let's use the spreadsheet for its intended purpose and look at the numbers one day earlier, the day before the X date. For the option quotes, I'm using the midpoint, and based on that information, the spreadsheet says the synthetic call will outperform the long call by about 4 cents. So let's look at how the two trades actually performed from one day to the next and see if the spreadsheet was correct. The day before the X date, the long in-the-money call was worth $9.87, and on the X date it was worth $10.15, a gain of 28 cents. And the synthetic call went from $39.76 to $39.84, a gain of 8 cents. And because you own the stock, you also get the 24-cent dividend for a total gain of 32 cents. So the synthetic did indeed outperform the long call by the 4 cents predicted by the spreadsheet. So does that mean early exercise was optimal? In this case it was not, and there's a few ways we can tell. The first way is the time value. Before the X date, the long call had 17 cents of time value, and exercising an option with time value is almost never a smart decision because exercising causes you to lose that time value. If the goal was to own the shares, you could instead sell the option and buy the shares instead of exercising, which allows you to keep that time value. The second thing we can look at is the bid-ask spread. Sometimes the spreads can be very wide, which can make it difficult to find a realistic value to put into the spreadsheet. But as long as we have narrow spreads on either the put or the call, we can use the put-call parity formula to find a realistic value for the other side. And we have narrow spreads on the put, so let's calculate the value of the $30 call on Bank of America before the X date. First, we have to isolate the value of the call in the put-call parity formula, which would state that the return on the stock plus the return on the put minus the interest on the cash difference should equal the return on the call. So that's the 24-cent dividend on the stock minus the 6-cent time value for the put and minus the 31 cents interest on the cash difference, which comes out to negative 13 cents. So a more realistic value for the call would be 983, where it had 13 cents of time value, instead of the 987 midpoint, where it has 17 cents of time value. If we use that more realistic 983 value, then the return on both trades ends up being the same from one day to the next, which means early exercise was not optimal. To help you with this calculation, I added an estimated value section on the spreadsheet for both the call and the put. And again, it's for situations where you have an accurate value for either the put or the call and you need help with the other one. And before you use it, it's important to enter all of the information on the spreadsheet with your best estimate first. Or instead of this formula, you can look at nearby strikes to help you determine a realistic value. For example, the 28 strike put has very wide spreads with no bid, a 42-cent ask, and a 21-cent midpoint. But if you look at the strikes above and below it, we can easily determine that a more realistic value is somewhere between 5 and 6 cents. And finally, the third and best way to tell if early exercise is optimal is to estimate what the time value of the call would be if the dividend did not exist, and compare that to the dividend amount. But first we have to look at how dividends affect put-call parity. The dividend would go on the right side of the formula because it's related to the stock performance, so we'll add the 24-cent dividend there. And on the X date, the stock will adjust down by 24 cents, which causes a 24-cent loss on both sides because the delta values on both sides are 1 or extremely close to it. So this makes the dividend a net neutral on the right side of the formula, but it's a net loss on the left side. So an adjustment has to be made to offset that loss. And that adjustment is a lower time value on the long call, which makes that call cheaper to purchase. Then on the X date, when the dividend is no longer a factor, the time value on the call will adjust back up. But there becomes an issue when the dividend is greater than the time value of the call, because the option price can't be adjusted down more than that. If it was, it would be trading below intrinsic value, which would turn into an easy arbitrage opportunity. So when the dividend is greater than the time value of the call, that call can't be fully adjusted down for the dividend, which causes it to be overpriced. And that's what causes a discrepancy in returns between the two trades and causes early exercise to be optimal. We'll look at this in more detail in our next example. Now, let's use our formula from earlier where we isolate the value of the call to one side, but this time we remove the dividend. And that formula tells us that our call should have time value of 37 cents, which is exactly what happened. Before the X date, the call had 13 cents of time value, and on the X date, it went up by the 24-cent dividend amount to 37 cents. The time value of the call without the dividend was greater than or equal to the dividend amount. Therefore, early exercise was not optimal. And put-call parity exists because on the left side of the formula, there was a 24-cent gain in the form of time value on the X date, and on the right side, there was a 24-cent gain in the form of a dividend. So basically, the day before the X date, if the time value of the put plus the interest on the cash difference is greater than or equal to the dividend, then early exercise is not optimal. Those two values estimate the time value of the call if the dividend did not exist. If those values are greater than or equal to the dividend, then the call can be fully adjusted down for the dividend and will therefore not be overpriced. Then on the X date, it can be fully adjusted back up when the dividend is gone. This means put-call parity exists and both sides of the formula will perform the same. So now, let's look at an example where early exercise is optimal. This is Bank of America again on June 6th, one day before their 24-cent ex-dividend date. But this time, instead of looking at the August 16th expiration, we're looking at June 21st. And just like before, we'll use the $30 strike. Now let's go ahead and enter the information into our spreadsheet, and for right now, I'll use the midpoint on the options. We also need a new risk-free rate because our option duration has changed. Initially, it tells us that the long call will underperform the synthetic call by 55 cents. But just like in the other example, we should look at each option and try to get to more realistic values. First, if we look at the puts, we can see that the 31 strike has an asking price of 2 cents, and lower strike puts should cost the same or less than higher strike puts, so a more realistic price for the 30 strike put is 2 cents. And the spreads on the calls are very wide, but because we already have a good estimate for the value of the put, we can use our formula from earlier to get a more realistic value for the call. But when we do the calculation, the formula says the call should provide a positive 15.5-cent return, which means it should be worth less than intrinsic value by that amount. But we know that can't happen, so we'll price it exactly at intrinsic value at $9.70. The spreadsheet knows this as well and also has the estimated value at $9.70. And if you'll notice, the estimated value section on the put says 17 cents, which is clearly way too high. That's because early exercise is optimal and it's calculating that value based on an inflated call price. So for the put, it's best to get an estimated value using the other method where you look at nearby strikes, unless you really know what you're doing. So now that we have realistic prices entered into our spreadsheet, it says the long call will underperform the synthetic call by about 15.5 cents. Let's compare the numbers before and on the X date to see if the spreadsheet is correct. Before the X date, the long call was worth $9.70, and on the X date, it was worth $9.825, a gain of 12.5 cents. And the synthetic call went from $39.72 to $39.80, a gain of 8 cents. But you also get the 24-cent dividend for a total gain of 32 cents. So based on these numbers, the long call underperformed the synthetic call by 19.5 cents, which was 4 cents different than the prediction. But we're dealing with the bid-ask spread on the X-date numbers as well. If we use the spreadsheet with the X-date numbers to get an estimated value for the call, we get 986 instead of the 9.825 midpoint. And based on that estimated 9.86 number, the difference in estimated versus actual performance was only half a cent. Even before looking at the X-date numbers, we could tell that early exercise was optimal. All we have to do is get the estimated time value of the call without the dividend, which again is the time value of the put plus the interest on the cash difference, which comes out to about 9 cents. If this amount is less than the dividend, then early exercise is optimal. Essentially what's happening is you have a call that should have negative 15 cents of time value before the X date, but arbitrage prevents that from happening. The left side of the put-call parity formula could only price in 9 cents worth of the dividend by reducing the time value of the call by that amount. Then on the X date, it will only go up by that 9 cents instead of the 24-cent dividend. The remaining 15 cents could not be priced in, which causes the call to be overpriced and therefore underperform the synthetic by that same amount. So if you have a choice to either hold the in-the-money call into the X date or turn it into a synthetic, the choice seems pretty obvious. You either keep the call and gain 9 cents of time value on the X date, or you turn it into a synthetic and gain a 24-cent dividend. And I just want to be clear that turning the call into a synthetic does not provide you any kind of advantage. It just prevents you from being at a disadvantage. In both cases, the positions would lose 24 cents from the downward adjustment to the stock on the X date. But on the right side of the formula, the dividend makes it neutral, while the time value gained on the left side causes you to lose 15 cents overall. If you hold a long in-the-money call into an X date when early exercise is optimal, the most you will lose on the X date is the total amount of the dividend. The sooner the option expires and the lower the strike means the more money you will lose, because that means there will be less interest on the cash difference and a lower priced put. And those two things determine the time value of the call on the X date. Now, let's quickly do one final example. We're again looking at Bank of America the day before their June 7th X date. It's the $20 strike for the August 16th expiration. But for this example, I want you to pause the video and see if you can figure it out yourself before we go over it together. This is what my spreadsheet ended up looking like. It's predicting that the two trades will perform almost exactly the same. The estimated time value of the call without the dividend is 24 cents, which is exactly the same as the dividend. So it's right on the edge of being optimal versus not being optimal to exercise early. And when you factor in transaction fees and bid-ask spreads, it will definitely not be optimal. If we compare the values of both trades before and on the X date, we can see that they both gained 32 cents, and the call had time value of 24 cents as the spreadsheet predicted. So that was the final example. Now I'll go over a few pieces of information and nuances that would be helpful to know before you use the spreadsheet and do some trades yourself. As with all of my videos, nothing I say here is advice or any recommendation to trade any particular security. Use the spreadsheet and trade at your own risk. If you've done research about this topic before, then you've probably seen some incorrect information out there, even from large reputable companies. For example, some companies suggest that early exercise is optimal when the corresponding put is less than the dividend. But this completely ignores the interest on the cash difference section of the put-call parity formula. In all three of the examples we looked at, the put was worth far less than the dividend, but early exercise was only optimal in one example. This is further proven by comparing the open interest numbers from one day to the next. For the August 16th expiration, the put was lower than the dividend for all strikes 34 and below, yet on the ex-dividend date, the open interest numbers were nearly identical to the day before. If these were indeed optimal to exercise based on the price of the put alone, then those open interest numbers should be a small fraction of what they were before. And that's what happened if we look at the June 21st option chain, where early exercise was actually optimal. But of course, some contracts remained open due to people not making the optimal trade. And what's even more surprising is some companies are suggesting it's optimal to exercise an option early if the time value is less than the dividend. But any seasoned option trader should know that exercising an option with any amount of time value is almost never a smart choice. Like we saw earlier, if the call still has time value the day before the X date, then that means it was fully adjusted down for the dividend, which means on the X date, it will fully adjust back up, resulting in equal performance relative to the synthetic. So exercising early in this case just means you're giving away your time value for free to someone else. The estimated value section on the spreadsheet might make it seem like I'm disregarding the bid-ask spread to a certain degree, so let me clarify what the goal of that section is. Market makers know what the price of an option should be by using the put-call parity formula or whatever other complex formulas they might use. Then from there, they set a spread in both directions off of that price where they are willing to buy or sell that option. On very liquid options, that spread is generally about the same in both directions, but on less liquid options, that spread could be very different on one side versus the other. And if another market participant like you and I puts in a limit price better than the market maker, then that will change the spread as well. So this means that the midpoint is often not a good indication of what the actual option price is. What we're trying to do with that estimated value section is find what the price of the option would be if the bid-ask spread did not exist, which is done by using the put-call parity formula or other complex formulas. The calculations we did up to this point should only be used if the stock only has one ex-dividend until the options expire. Things get more complicated when multiple ex-dates are involved. But if this video gets enough positive feedback, then there's a good chance I'll make a follow-up. For right now, if you have an in-the-money call with multiple ex-dates until expiration, here's something you can do. Plug in the information in the spreadsheet like we did before, but in the dividend amount section, put the total dollar amount of all ex-dividends until expiration, instead of only the next one. And obviously you might have to guess a little bit if they haven't been announced yet. If the spreadsheet says the synthetic call will outperform the long call, then you could be disadvantaged by that entire amount from now until expiration. But exactly how much is lost on each X date will be discussed in the follow-up video. In the video, we didn't talk much about fees because they can vary greatly from one person to the next, depending on your broker and what kind of negotiated commission you have with them, but you should definitely take them into account when deciding which trade is optimal. We also didn't talk about what to do with the trade after the X date. Some people may want to keep the synthetic, while others may want to turn it back into a long call. At that point, it doesn't matter a whole lot on which one you decide because the dividend is out of the picture, and both trades should perform almost exactly the same from there. But if you decide to turn it back into a long call, then you'll have to deal with added fees and the bid-ask spread. And the synthetic uses extra cash like we talked about before, which is priced into options at the risk-free rate. So if you're on margin with this extra cash paying more than the risk-free rate, then that will be to your disadvantage. But on the contrary, if you had extra cash and it was otherwise receiving a low rate of interest, then spending that extra cash would instead work to your advantage. It's rare for a dividend stock to have a hard-to-borrow fee, but when it happens, the spreadsheet probably won't work correctly because that fee affects option prices. I may go into more detail on this in a future video. Thank you so much for watching. If you enjoyed the video, please give me a like, subscribe, and comment so that YouTube recommends this video to more people. And like I said before, if I get enough positive feedback, I'll probably make a follow-up video about long calls with multiple X dates until expiration. And maybe I'll even show you how I'm using the concepts discussed in this video to make risk-free money. Financial Pickle here, keeping you out of the pickle jar.